Hey, how you doing? This is Adam Post, publisher of more than 1,000 comic books and marketing expert covering Disney. Disney, of course, needs to figure out what to do with their business, how to get their stock price up. The stock price is down again today, but now they've announced they're going to spend $60 billion over the next 10 years expanding their theme parks internationally. They spent $30 billion in the last 10 years. Now with announcing they're going to spend $60 billion, they're desperate and hoping to get some life back in the stock and some life back in the company because the film and TV businesses and their cable business in particular is not doing well. Let's get into the story. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. I really appreciate you guys. Coming from the New York Times, Disney challenged elsewhere plans to spend $60 billion on parks and cruises. Amid uncertainty for the company's film and TV divisions, the investment over the next decade doubles the outlay in the last 10 years. It is true Disney has been going through some trouble lately. They recently announced they had to write down $2.4 billion worth of their content that they spent for streaming services just over the last couple of years. What that means is it's a loss. But by taking that loss all at once in one quarter, it'll make their future quarterly profits look more profitable. A lot of this is about accounting tricks and accounting gimmickry. I'll get into that in a little bit more detail. Disney's streaming business is in trouble, according to 24/7 Wall Street. They've had to adjust internally for much lower streaming service subscribers for Disney Plus and for Hulu ever since they've raised their prices, but also since they focused more on trying to make it as profitable as possible. And of course, they're losing millions and millions of subscribers all over the world. They also need to figure out what they're going to do with some of their channels from their linear cable division, because 8 of them were not picked up to be continued by Charter, a major cable company distributor, who was also able to get Disney to give them their streaming services for free. What are they going to do with all these employees for Freeform, for example, if they've lost 20% of their customer base when Charter dropped the channel? The answer to that is, well, at least they can commit to spending billions on theme parks, because that business, even though they had some trouble this summer with some empty theme parks, still generates money for them, and for the most part, customers have accepted all their price increases. Disney theme parks will generate an estimated $10 billion in profit this year, up from $2.2 billion 10 years ago. Not bad for a 68-year-old business, especially considering the devastation wrought by the pandemic just a couple of years ago. So with theme parks making money, if they announce they're doing more theme parks, shouldn't that make the stock more valuable? Disney certainly hopes so. Last month, when Bob Iger, Disney's chief executive officer, singled out the parks division as a key growth engine on an earnings-related conference call, Wall Street was surprised. Disneyland in California has long been viewed as maxed out with little room to expand. Walt Disney World near Orlando, Florida has become a question mark given that Iger has said his company's legal battles with Florida could imperil a $17 billion planned expansion over the next 10 years. Disney's overseas parks, aside from Tokyo Disney Resort, which it receives royalties from but does not own, have sometimes struggled to turn a profit. There is no way that Disney is not going to invest as many billions as possible in Florida. They're just not going to do it as profitably because they destroyed the relationship with the state. On Tuesday, Disney offered a clearer picture of the opportunity it sees, which can only be described as colossal. The company disclosed in a security filing that it planned to spend roughly $60 billion over the next 10 years to expand its domestic and international parks and continue building Disney's cruise line. That amount is double what Disney spent on parks and the cruise line over the past decade, which itself was a period of greatly increased investment. There are all kinds of accounting tricks they can use when they make investments in real estate, and they do have a proven history of making money at the theme parks. So it is, generally speaking, legitimate, and I haven't seen any investors or any analysts really object to them spending money on their parks. This will increase their business, and it's a reasonable thing for them to do, especially given all the trouble with losing money on films and losing money on the streaming service. In the past decade, Disney has opened Shanghai Disney, more than doubled its cruise line capacity, and added rides based on intellectual properties like Star Wars, Guardians of the Galaxy, Tron, Spider-Man, Avatar, and Toy Story to its domestic parks. Disney has also poured money into its Paris and Hong Kong parks, with themed expansion tied to Frozen and other Disney films scheduled to open soon. 3 more ocean liners are on the way, bringing the Disney fleet to 8 ships and Disney is nearing completion of a new port on a Bahamian island. Disney already has one private island port. If that's what $30 billion can buy, imagine what $60 billion can buy. Quote, there are far fewer limits to our parks business than people think, Iger said in an email. The growth trajectory is very compelling if we do nothing beyond what we have already committed, he continued, referring to attractions and ships that have been announced but are not yet operational. By dramatically increasing our investment, building big, being ambitious, maintaining quality and high standards, and using our most popular IP, it will be turbocharged. This is unlike their cable business, which they don't really control. They have to convince cable companies to carry their cable channels. They used to be able to just say, look, ESPN plus everything we are selling you, or you're not going to get ESPN, and cable channels were stuck paying for that, which generated and continues to generate billions and billions of dollars for Disney in revenue and profit. And those cable channels are used to create content they can then restream, especially on Hulu, at really almost no cost to the Hulu division once the cable channels have paid for it. But since the breakup with Charter, they don't have that same guaranteed revenue they used to have. They still have a very lucrative deal with Charter. They still have very lucrative deals with other cable companies, but it is starting to fall apart. Disney is expanding the investment after a stretch of trouble in almost all of its divisions. Cable television, including ESPN, has become a shadow of its former self, the result of cord cutting, advertising weakness, and rising sports programming costs. Also, the wokeness of ESPN, you really can't ignore that. It's not the same experience it used to be. Disney had a disappointing summer at the box office with movies like Indiana Jones and the Dial of Destiny and Haunted Mansion selling sharply fewer tickets than anticipated. The company's Disney Plus streaming service continues to lose money. Iger has said it will be profitable by the fall of 2024, but some investors are skeptical. Disney shares closed Monday at $85. Their price was $197 in just 2021. If you look at Disney stock today, it's at $81.96, which is relatively close to their 52-week low, and being off over 3% just today is not a good sign. In contrast, Disney's parks and cruise businesses had been a bright spot, in many ways propping up the whole company. In the most recent quarter, Disney Parks Experiences and Products generated $2.4 billion in operating income, an 11% increase from a year earlier. $2.4 billion in one quarter is good numbers. Some of that could be funny accounting, but the numbers are accepted by Wall Street, so it's legitimate operating income. Disney Media and Entertainment Distribution had $1.1 billion in operating profit, an 18% decline. Spending per guest at Disney parks has increased 42% since 2019, in part because of higher prices for tickets, food, merchandise, and hotel rooms. And that's where the profitability is coming from. A 42% increase in revenue per guest since 2019 is astronomical. Quote, the stock is cheap given how good the parks are, Michael Nathanson, an analyst at SVB MoffettNathanson, said on Monday before the expansion was announced. Still, increased investment in theme parks brings increased risk. It's a business that will always be sensitive to factors beyond Disney's control, such as swings in the economy, gas prices, hurricanes, earthquakes, tension between the United States and China. Disney has greatly increased security, deploying undercover guards and installing metal detectors, because of course they have brawls now. But these teeming resorts, Disney parks attracted an estimated 121 million visitors last year, could become ghost towns if a violent event ever took place. Josh D'Amaro, chairman of Disney Parks Experiences and Products, said people who focused on such risks overlooked the resilience of theme park fans. He noted that customers had come flooding back when Disney parks reopened during the pandemic. Quote, every time there's been a moment of crisis or concern, we've managed to bounce back faster than anyone expected, he said. They also went through the 9/11 attacks. They closed them down. They had to open them back up, and it worked again. D'Amaro declined to specify how the company planned to spend the $60 billion, but he gave hints, noting that Disney movies like Coco, Zootopia, and Encanto, and others had not yet been incorporated into the company's parks in meaningful ways. Quote, imagine bringing Wakanda to life, referring to the fictional Black Panther Kingdom. In terms of bringing the latest Disney, Marvel, Pixar intellectual property to the parks, we haven't come close to scratching the surface. And we've learned that incorporating Disney IP increases the return on investment significantly. And that is the pitch to investors. And that's why they can put high valuations on anything they decide to invest in. So if they spend $60 billion on the parks, it's expected it's going to create at least $120 or even $180 billion worth of value. Will it actually create that much value? A little bit hard to say. Disney owns 1,000 undeveloped acres across its existing theme park resorts, according to Amaro. For comparison, he said that's the size of 7 Disneylands. One of the biggest areas of opportunity, he said, involves the original Disneyland, which opened in 1955, if the company can persuade the city of Anaheim to change a plan adopted in the 90s that limits where hotels, parking lots, and attractions can be built. Disney intends to redevelop land adjacent to Disneyland, greatly expanding capacity. Disney also plans to turn a parking area south of the park into a themed shopping, dining, and hotel district. At the moment, Disney does not plan to build parks in new countries or cities. In the past, the company looked at building a park in India, for instance, and expanding beyond Hong Kong and Shanghai. Rather, the company will focus on developing new ports for its ships, which is a very conservative thing to do. It's a non-risky thing to do if they're going to build a brand new park in India somewhere or in Bangladesh or who knows where. That's a lot more risky than an expansion. Starting in 2025, a new cruise ship, the biggest in Disney's fleet so far, with space for more than 6,000 guests, will be based in Singapore. Disney ships have grown increasingly themed, with characters and artwork from franchises like Frozen, Star Wars, and Marvel's Avengers incorporated into restaurants and entertainment zones. Quote, "It's like bringing a theme park to a new part of the world," Mr. D'Amaro said of Disney's cruise line, which has recently been booked to 98% of capacity. If you're at 98% of capacity in anything that you're doing, that's a good opportunity. Even if Disney Plus continues to lose $3 billion a year, if they're making $8 billion a year on theme parks, they're ahead of the game. Their films are losing money, but if they lose $1 billion or $1.5 billion and they're making money in theme parks and they're making money still with their cable TV, linear TV businesses, they can still continue. The biggest problem with Disney is they don't seem to have a vision because they have no creative core. They have no center because they're too focused on pushing representation in all their brands. The theme parks will make money, the cruises will make money, but when you ask, like, what is the Disney brand and what's the company about, all you can come back to is the woke representation. When it comes to representation, there's no story there. There's just physical characteristics. That's the big problem. There's really nothing inherently special about Disney anymore. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up, and I'll see you again soon with another video. And if I don't see you, I will miss you.